Hello. Thank you for joining us on Minds of Commercial Real Estate. Today we have Kashi Dolachai from KDOW Financial Insurance Services.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Today we have Kashi Dolachai from Art of Insurance.
How are you doing today?
I'm good. How are you doing?
Excellent. Thank you for having me.
Thank you for coming on the podcast. We've known each other from back in the New York life insurance days.
Absolutely.
Back in 2005, 2006.
Yeah, it's been about 20 years.
Yeah. So, and throughout the whole, this whole 20 years, we've been in touch and you've helped a lot of my clients with their life insurance needs. And we just want to speak today on, what's going on in that market and what is going on with life insurance, the type, what's out there and what it's being used for in today's market.
Actually, it's changed a lot since the old days. The life insurance industry has evolved with the needs of the people. There are a lot of different policies out there now, aside from your traditional term and whole life and regular universal life. And I will explain the difference between the two. But there are some other ones that have built-in features in them that help you with living benefits. The difference between permanent and term insurance, I will explain briefly. Term insurance is like renting a home. It's good for a certain period of time. A lot of my clients use it as a stepping stone to get protection for their families, mostly young families. Or if you have SBA loans, I find there's a lot of SBA loans that require term insurance. So it's for a certain duration. You do it and you're good. Permanent insurance is more like purchasing a home. In this home, you build equity. You do the same with permanent insurance. Whether it's whole life, universal, or index life policies, you have a cash value component that continuously builds. And later on down the line, you have options of not making any more premium payments and letting the cash value pay for it, or getting some income off it. And kind of like how the mortgage industry has evolved, kind of like a reverse mortgage. You have equity in your home, you're older, you don't want to make any more payments. If you, let's just say, are still making payments because you happen to refi or something, and you get to no longer make payments, cash out a little bit, use it for your retirement. The only difference is when time comes and you pass, life insurance actually pays you for their death benefits tax-free. There's a lot of tax advantages in permanent insurance.
So I've done many of these term loans for the SBA loans. And can we speak a little bit further on that and why the SBA might require them?
What the SBA does is they have a collateral assignment. With that collateral assignment, they want to make sure that their loan is secure in case you die. As the loan is paid off, the collateral assignment gets less and less to the balance of your loan. So I have a client who recently did a $5 million policy for a loan. 10 years down the line, let's just say the balance is $3.8 million on the loan. SBA will get paid out $3.8 million. They're made whole. And the balance of $1.2 million is going to the family or whoever the beneficiary is, tax-free.
Okay, very nice. Let's go a little bit further and speak about, universal life and variable universal life.
Universal life policy is more customizable. A universal life policy allows you to pay less based on your financial situation every month, or if you have enough cash value, skip a few months, or you pay extra to put extra money you pay a little bit extra in order to put additional funds in your cash value so you can use later. A universal life policy does not have all the guarantees that a whole life policy has. It is driven by the interest rate market. As a result, we experienced back in the early 2000s very low interest rates. So the cash values were not performing that well. Now we're in a higher interest rate environment. And even before us, if you go back to the 1980s, people who had universal life policies they really rocked. A variable universal life policy has several separate accounts. These separate accounts allow you to invest in the stock market based on whichever mutual funds you decide to go into. They're called separate accounts, but they mimic a mutual fund. This allows you to grow the money at a much more rapid pace. However, you have market risk. When you have a downturn in the stock market, the cash value of a variable universal life policy will also go down. Problem with that is, if you don't properly fund it and it goes down too much for an extended period of time, you have to put a lot of extra premiums in order to make it stay in force. If it collapses, then it's just a very expensive term policy. The beautiful part about a variable universal life policy is the potential for high growth. As the cash value builds, like the stock market, you will be able to use that money to supplement your retirement. Granted, you have to make sure that over certain markers in your life, turning a certain age, having your risk tolerance be a little bit lower, preserving some of your capital, you have to manage it. You have to sit with your agent and ask them. I'm now, let's just say, 45 years old, 50 years old. I want to retire at 65 or 67. I may not have the very aggressive risk tolerance anymore. I want to preserve some of my funds. Your agent will recommend, okay, we're going to take 40%, 30%, whatever it is that you work on, and make it less risky so that if there is another downturn in the market, you have some of your cash protected. Now I'm going to throw in an additional product. There is a series of products called indexed universal life policies. They are for people who may not have as high of a risk tolerance level, or a lot of my clients invest separately in the market. They want to have better than average returns in their life policy, but they don't want to have the risk. An index product will perform mimicked by certain indices. S&P 500s. Let's just use that. The S&P 500. So if the S&P 500 really does well, your policy does well. There is definitely a window in which you can go up to. Let's just say, and I'm going to make these numbers easy, there is a 10% cap on your indexed universal life policy. S&P 500 averages 20%. You will only get 10% on the money. At the end of the year, they'll calculate it, you get a 10%. Because the company is taking on all the risk.
Is there a floor?
God, you asked that. There is a floor. It's zero. If anybody remembers around 2009, 2010, we had several years in which the market really did not do well.
Sure.
If you would have had this product, you would have a zero.
No negative. So every year, if the growth grows, the following year, that's your floor rate.
Absolutely. So if you have $300,000 in a variable universal life policy, $300,000 in an indexed universal life policy, now the market drops 50%, you now have $150,000 in cash value for your variable universal life policy. Granted, I'm making the numbers easy for us here. Now that $300,000 does not drop. It stays $300,000. The following year, you just get zero returns on that money, but you don't drop. Now, if the market climbs back up again, you're starting at $300,000 going up, while somebody with a VUL is at 150 working their way back up. It's for people who want to have better returns and don't want to have risk. Of course, I have to do the disclaimer. All investment products have certain level of risk. Everything doesn't perform exactly as one would illustrate. So nobody has a crystal ball. But at least you know with an index product, there is no negatives.
What about where a individual pays for life insurance from their personal account versus a business account? What is the consequences?
If you pay from your personal or business account and you happen to be a S Corp, LLC, it just counts as your income and there's no consequences. If you write it off. Now, if you write off your premium that you're paying through your business account, that's a problem. The IRS will consider it as pre-tax dollars being used, and they will tax your death benefit.
Got it.
And there's a lot more involved with that, but we won't have the time to get into
Sure.
it now.
And they can speak to their CPA to get more
Absolutely.
details on that.
Don't write off your premiums for your life insurance policy or your disability policy. That's a rule of thumb.
Got it. Now, let's go into a very unique product which you have an offer, which is premium financing life insurance. Let's give a very synopsis kind of, story. And then for each individual or family, it's going to obviously be separate, what they're looking to obtain from it, but give kind of a brief of how that works.
Absolutely. There is traditional premium financing where a client, usually high net worth individuals who need to have really high death benefit, and they don't want to put all the money out because they're business owners and they use their money to make money. What they'll do is they'll take a loan out to pay the policy premium. It's got advantages and it's got disadvantages. You have to have collateral. They have to do a financial underwriting on you. You have to have a personal guarantee. And the bank could at any given time call the loan in. This is for clients who are very well established, have a lot of liquid income, or have a lot of assets that they can tap into. We've done those, and prior to 2009, we were doing a lot of those. Problem was 2010, 2011, the bank started getting very, very nervous. So they started calling some of the loans. And that spelled some problems for certain clients who had a risk that went alongside with what happened in the markets. I have a client who had a lot of multifamily housing. They weren't as impacted because they still got the rent. I had a client who was a builder. He really was impacted, and it caused issues for him. Now, there is a different product where it uses the indexed universal life policy that we spoke about, and it uses that as the funding mechanism. Because of the guarantees in the indexed universal life policy, the lenders do not require credit checks, personal guarantees, or any collateral. They use the policy as the collateral itself. For the first 5 years, they will share the premiums with you. You pay 50%, they pay 50%. Let's say you're committing to $50,000 every year. The bank will put in the other $50,000. That's for a 5-year period. Second 5 years, they pay the whole thing. The bank covers the full $100,000. At the 15-year mark, the bank takes their money, takes their interest, walks away.
Who pays from 11 to 15 years?
Nobody. There's no premium payments. You just let the cash value build.
Okay.
Once the bank sees it's safe to pull their money out, they will pull their money out, leave you with the policy. They wash their hands from everything.
And they're not a beneficiary anymore at that point.
Nope, they are not. And the beneficiary, the level that the bank is a beneficiary on that is only for the amount that they've loaned plus their interest. So if you have a $4 million policy and they've loaned you $1 million plus another $120,000 for interest, they're going to take $1.12 million. The rest goes to your family, tax-free. What my clients use this for mostly is supplementing their retirement. It is a personal pension, really. So the way I design it is we work with a company that has been doing this for many years, and they have a little over $7 billion loaned on these policies. And the banks absolutely love it because there is no floor. The potential for higher return for the bank is an asset. They know they're getting their money back. They know they're getting their interest, no matter what. The insureds love it because they get to, like I said, supplement their retirement. I will talk about one that I recently did. 33-year-old male committing to, we'll make the number $50,000 to make it easy. Pays for 5 years, $250,000 out of pocket. The bank paid the rest, $750,000 over the 10-year period. They walk away. The bank takes their money, takes their interest, they're gone. My client's retirement age
At 65.
well, in his case, he wanted 67 because he wanted to match with his Social Security. Based on the performance that we are expecting, he is looking at pulling out $191,000 a year, tax-free, for a 25-year period.
Wow.
That is huge.
It's compound interest in the works.
Compound interest, absolutely, and a higher return. Plus, there's a floor. There's no negative return.
Sure. Every year it builds up on
If we go through another 4 or 5 year period in which the market is negative,
this is
zero. You just don't get an increase. So maybe instead of age 67, you retire at 69.
sure.
At age 69.
Right. 2 years later than expected.
Or you take a lower benefit. This policy is stress tested incredibly.
Thank you, Cassie, for that amazing product. It sounds very interesting. And I think that's one that a lot of people don't know about and probably would like to learn more about. What else is it that would you like the viewers to know?
I would like the viewers to know a little bit about how this policy is stress tested to make sure that the investment has all the protection you can get. There is 2 types of stress testing done on this. It's the Great Depression stress testing and the 1980s high interest scenario that we had. For the Great Depression stress testing, they showed out of 12 years, 9 years of zero returns. And with that very aggressive scenario, because the Depression didn't have 9 years of negative returns, and remember, it's going to be a zero no matter what. It's not going to be a negative. The person went from $191,000 of income down to about $166,000
At year 60 something, age 67.
And when we did the high interest scenario, 1980s, getting we went up to 16.88%, which is what happened in 1980s. Out of a 15-year period, we had high interest rates for 12 years of it. As a result, the money that client would be pulling out, because remember, this has a cap, no floor, and its interest rates, actually high interest rates, perform better for the policy. He only had I believe it was like an $11,000 a year deduction in how much he would take out. So it's going to be about $170,000, somewhere around there. $180,000. That's $180,000. I want to repeat that. Based on those interest rate environments, he is looking at about $180,000 in money that he gets tax-free.
That's amazing.
Absolutely. And there's death benefit when he passes in the later years. And there's also a living benefits component, which we'll talk about next time, which allows you to use the money to pay for long-term care, which I consider the Titanic of people's retirement.
Absolutely, in today's world.
Absolutely.
Well, Kashi, thank you for all the knowledge you provided today. If somebody wants to contact you, what's the best way for them to get in touch with you?
My pleasure. If they want to get a hold of me, they can contact me via email at kashi@theartofinsurance.com, KASHY @theartofinsurance.com. I'm sure we'll put it up on the board. It was a pleasure. Thank you for
Thank you, Kashi. Thank you for being on the show again.
Looking forward to being back.
Yes, very soon.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.